special or fashionable. Fog scent. New fashion wear for men.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Independent market expert Dharmesh, Senthil Manikandan of Newberry Capital and Urmil Shah of IDBI Capital join us on the show. Today on Hot Money, we'll discuss stocks like Marico, AB Capital, Tech Mahindra, as well as Venky. So these are the stocks that we will be targeting in today's show. Let's start with the first one. The first stock that we want to speak about is Marico. Now, copra prices have actually cooled off more than 15% in the past 1 week. Is this a trigger for someone to start accumulating Marico? And Marico of late has not been doing well. So, Urmil, is this the right time to accumulate Marico? You have 1 minute for your opening statement.
Yeah, we would say so. In fact, we believe that stock like Marico is a must-have stock in a long-term portfolio. So if you see over the last 1 year, Parachute had to take almost 30% price hike, all driven by higher input prices. Now, if there are also question marks whether the double-digit growth in volume can continue with such high prices. So any cooling off in the copra prices, which we have seen in the last few weeks, should help them to reverse the price hikes which they have taken, which would enable them to maintain a double-digit kind of volume growth. We need to keep in mind that Saffola is not doing well because of higher competition, and Parachute is extremely important for Marico, given 25% contribution to the revenue. So the signs are good as regards what could happen in FY19 for Parachute, and that's why we believe it's a good level to accumulate.
Okay, so it's the first. Urmil does believe it's a good time. Dharmesh, your view on Marico? Should someone accumulate Marico now?
Yeah, definitely yes. For the last 1 year, if you see at the stock price, there hardly been any movement in the stock price. It has not moved at all, and input prices falling down as to the margin. And what Marico has done of late in last 1.5 years, they have able to improve their margins. So operational efficiency has been playing out for them. Volume growth looks difficult. Top line growth has not been the way it should have been, but the foray into the emerging markets is the key trigger going forward. So I do think at current valuations, it's cheaper than most of its peers by 10-15% on the valuation metrics. So I do think one should be accumulating Marico at current levels. Okay,
so two of our guests do believe that Marico should be accumulated. And Senthil, do you share the view or you have a different view?
So I have a different view because if you see in Q3, the copra prices have been up nearly 90%. So since then, I think since starting of March, it has declined around some 10-15%. Because the new season is starting this month, so copra prices which are trading at a range of 15,000 per quintal, it is now trading at around 12,500, 13,000 range. Because of that, their Q3 margins, the gross margin got impacted by 5%. And as Urmil mentioned, there are other segments except the Parachute, the Saffola facing heavy competitive pressures. So at present, if you see last 12 months, the stock has been underperforming the broader market index and also even its peers. And at 40 times 1 year earnings seems a little bit expensive for your growth prospects considering the next 2 to 3 years.
Okay, so I think two of our guests do believe that it should be accumulated. Senthil does not believe that it should be accumulated, but we'll throw it open. So he made a good point, for a company which is not growing, margins up 20% over the past few quarters, they haven't been able to grow. Why should someone give a valuation in excess of 40 times? You said it's at a discount, but the other companies are growing in the FMCG space, while Marico has remained stagnant.
See, of late, with the emerging market if you see the traction in the emerging market from 15-16% kind of top line traction, it is now 23%.
Okay.
So that traction has been there, and their products are well known. Be it Livon, be it Nihar, be it Parachute, be it Saffola. Saffola has its own headwinds. So I do think this emerging market play would be the next trigger for Marico.
Okay.
Balance sheet is clean, cash flows are intact. Yeah, the growth was the concern, but this growth is going to come from there.
But how's the traction been in the emerging markets for Marico? Are they getting good traction? Are they getting good margins for these products?
Yeah, definitely. That is the reason why your margins have improved.
Okay.
Operating margins and PAT margins have improved for Marico because they have been getting traction.
Okay.
At the same time, you know, the revenue contribution has also increased from 15-16% few years back to 23% now.
Okay.
And management is focused. If you look at their commentaries, they are, you know, heavily focused on most of the emerging market countries, African countries, and the price sensitivity to which Marico plays out.
Okay.
So that would play out there as well, as it has been playing in India.
Okay. Urmil, do you all have active coverage on Marico as IDBI?
On the retail side, we have been recommending, you know, Marico quite regularly because, you know, we need to keep in mind that here we are focusing on a very strong brands. So Saffola is definitely facing problems because of lower input prices for the rice brand oil, the competition. But you know, this cyclical nature of inputs, it's very difficult to predict. So whenever this reverses, you know, brands like Saffola should be able to you know, get back their market share. As regards Parachute, it's much stronger. It has a much stronger presence in the coconut hair oil segment, more than 50% market share. So there we are more or less comfortable. Okay. And in fact, we believe that lower copra prices and Parachute doing well should help the overall you know, performance of Marico.
Okay, I think we need to move to the next stock, but I think the general consensus we are getting is two of our guests are bullish on Marico at this point of time for a long-term accumulation. Senthil pointed out that, you know, for a company which is not growing I think valuation seems to be the big concern that he is having at this point of time. The next stock that we want to speak about is AB Capital. The stock is trading at fresh 52-week low. News also coming out in terms of getting an ARC business license, but that does not seem to excite the stock. Ever since it's listed, it's just gone down. So what seems to be the trouble, and is this the right time to start buying AB Capital? So Senthil, should someone buy AB Capital?
Yes, we also think so, because if you see 6 months back, the entire NBFC sector was in euphoria. At the time, the Aditya Birla Group also did a restructuring, and then we got the AB Capital. And if you see the AB Capital's business, like either it be the life insurance or the NBFCs and the AMCs, I think the financialization of savings trend, I think it will play out in the next, maybe not in the 1 year, but 2 to 3 years time frame. And AB Capital has a lot of strength within this group structure itself. So if you look at the valuation side, at 150 rupees, I think it's at a fair valuation, because they have NBFC business which is growing at around a 40% CAGR in the last 4 years. Even the AMC business, they have around 10% market share in the equity segment. And in the SIP book, they have around 12% market share. And all these segments are growing at around 25 to 30%. So definitely there is growth in the business. Only concern is their life insurance business, which is not performing well.
Okay, so I'll get back to you on that, on the life insurance business. Your time is up. Urmil, should someone buy AB Capital?
So clearly, you know, recent 6 months or so has proved that, you know, holding companies are not the stocks which investors like. You can look at performance of Reliance Capital as well. Okay. So from the next 1 year point of view also, I agree with Senthil that it from a 1 year point of view, it might not be a buy. But if somebody has a 2 to 3 year horizon or longer than that, definitely the asset management business, financial services are very, the company has very strong presence, both from a business growth point of view as well as value unlocking from a potential stake sale or listing. Both are the areas where you know, there could be an upside from a 2-3 year point of view. And you know, a console price to book of 2.4% isn't very expensive, but for a consolidated ROE of 13% in the very short term, one would not you know, buy as well. Okay. So if there is a longer term horizon, it's a buy. Okay,
so we'll get back to it. Dharmesh, you don't have a view on AB Capital. So we'll throw open the discussion. Senthil, you were talking about some insurance issues with the life insurance business. So you can just highlight what you were indicating.
So in the life insurance sector, as per se, is dominated by the companies like HDFC or ICICI, SBI. Those have a backing of a bank insurance channel. It's promoted by the banks. So, but when you look at the other companies which are promoted by non-promoted like Max or these finance, they are finding it difficult to compete with these guys because on the cost effectiveness of the bank insurance channels that HDFCs or SBIs has. And also we have seen last 3-4 years it has been underperforming. So that's the only concern or the risk I see in this AB Capital business as per se.
Okay, but what seems to have gone wrong for AB Capital? Because it's underperforming all the other stocks in the NBFC space. So the others, no doubt, all of them have come down. But I think there is some issue. Is there some? Can you venture a guess in terms of what seems to be the problem that investors are having with AB Capital?
Our guess is, if you look at all the businesses which have got listed in this space, they have done well. So even if you look at how HDFC Life or other life insurance companies have done well. So the preference has been a direct investment rather a channel through holding company. Okay. That's our only guess. Why the stock has not done well. If you look at the businesses itself, the AMC front, they have done well. Financial services, they have done well. Life insurance is the only parameter where they have underperformed its peers. But my sense is that still for the next 6 months to 1 year, preference will be towards direct exposure to insurance or mutual fund.
So your view is basically holding company discount is something that they're saying. We don't track it, but are you aware of why investors seem to be shunning AB Capital as such?
See, primarily a company which is purely focused on AUM asset management businesses won't be doing very well. This is from medium-term perspective as well, 2 to 3 years perspective if you look at. So I don't see much growth opportunities coming in, AB Capital, Reliance Capital kind of companies. If it's a pure NBFC play, it's a different ball game. Pure banking play, it's a different ball game. HFCs are a different ball game. But AUM kind of a play, because competition will heat it. It's already heated up. At the same time, the fee structure is going to fall down because of the increasing competition and direct, through digitization and all. So that margins are also getting squeezed. So there is no incentive for the end dealers, the intermediary who were there, who used to, get businesses for them to source the business. At the same time, the way market is behaving. So that's a big concern. That will have a overhang on companies like this. So
I think the general view that we are getting on AB Capital, nothing will happen at least in the near term. But both of our guests do believe that the potential for a long-term investment certainly is there on the counter. The next stock that we want to talk about is Tech Mahindra. Stock is trading at a fresh 52-week high, but today it's trading slightly lower. But nevertheless, the rally has been stupendous for Tech Mahindra. Will the rally continue? That's the big question that we are asking. Dharmesh, you go first. Will the rally continue on Tech Mahindra? I
think so. It should continue. Maybe a small correction in the near term, but from medium to long term perspective, it's still, not very highly valued. So there's a valuation gap out there in Tech Mahindra. If you look at the business, post-acquisition Satyam, things have, played out well for Tech Mahindra. And in the digitization front, they have seemed to get the things right. If you look at the Q3 earnings, it was a stupendous kind of earning growth with 70% kind of a PAT growth has been there. And this year, likely the EPS would be in the range of 40-41. So last year EPS was 30. So 30% growth in the EPS you are going to get in Tech Mahindra. And going forward, even if 15% kind of a discounting you give, growth if you give to EPS trajectory. So 50-55 is a likely trajectory. So at 15 times 800 plus kind of a valuation it stands on FY20 earnings estimate. So to my mind, the numbers are reflected. The management claim that digitization is doing things for them. That's there in the numbers to see. So it's a good play. So a lot of scope still there.
So he believes that there could be potential upside. Senthil, do you think that the rally will continue in Tech Mahindra?
Yes, I also think so, because see their revenue streams. I think around 50% of the revenue comes from the communication vertical. And lately what you are saying is like there was a new capex coming in from the telecom players, like for the 5G introduction. And Tech Mahindra being a largest player in the communication vertical, I think last 2 to 3 years there was not much new capex coming in the communication side, so they were underperforming. So but now I think the communication vertical will fire up, and there is a lot of good prospects for a double-digit growth for the next 2 to 3 years. And like Dharmesh mentioned, valuations are also very cheap. I think with the digitalization of the enterprise segment is also picking up. So we are positive on the stock.
Okay, positive. And do you believe that it will continue, the rally on Tech Mahindra?
It would continue, but it would be more driven by the rally in the sector as a whole. But amongst the large caps, we believe that Tech Mahindra, after a 45% up move in the last 6 months, would underperform because we believe that it's almost at the same valuation as Infi is trading 15 times on FY20 earnings. Also, we believe the uptick in the communication segment is extremely important for it to get to a double-digit revenue and earnings growth in FY19 and 20. We believe that the communication uptick will happen towards the second half, or it will be back-ended on FY19. They have done well on the earnings front, EBIT margin improvement front, but I believe the major pickup is behind because they are working with almost zero bench. Utilization is at a level where further improvement might not be there, and they haven't taken any salary increase last year.
Okay.
All that should come in FY19.
Okay, so we'll discuss that. So I think the broad consensus we are getting is the fact that it's a consensus buy, and if you see what's happened on a year-to-date basis, the Nifty IT index is up 10%, while all the other indices are in the negative. So that gives an indication that there is significant amount of strength. In fact, it's a double-digit growth for the Nifty IT compared to somewhat like a PSU index, which is down over 20%. So strength is definitely there. I'll leave it to where you were saying. Can you explain in more details the FY19 in terms of this bench strength and utilization? How will that work for Tech Mahindra's favor? And what was it that led the overall rally in Tech Mahindra much faster than the benchmarks like the TCS Infinity? Why was it Tech Mahindra able to outperform the others?
Sure. So if you see, if I remember it correct, Q4 of FY17, they had gone to EBIT margin of single digit, that is 8.4.
Okay.
This was basically they were doing a lot of restructuring with LCC, the network services business which they acquired, which has not done well for them, and growth was also muted. But enterprise segment has done well in the first 9 months, and they are back to 11-12% of EBIT margin. So it's almost a 400 bips improvement, which was a beat to the consensus. But this has happened at a time when they have optimized the headcount, which has seen a decline, and the utilization rate is very high, almost with zero bench. So when actually growth comes in the communication segment, they will have to do away with zero bench, and because communication segment growth coming in, they will be generally longer term contracts, which you will not be able to operate in with the same matrix. And no salary hike in 1 year is okay. Next year definitely they will have to bring that up as well. So I think the EBIT margin improvement, major chunk of that is behind. As regards growth, we are penciling in about a 8% CAGR over the next 2 years. Because yet we are not penciling a communication segment growing in double digit. So for a double digit growth for a company as a whole, communication segment needs to come up, which right now we don't think, because within communication the wireless segment is doing well, but the wireline and the network services segment for Tech Mahindra isn't doing well. Okay,
I think we'll need to move to the next stock, but that was a comprehensive view that we got on Tech Mahindra. And the final stock that we are talking about is Venkys. It hit a new high of 4,500 today. I think it has cooled off from that level again back to levels of 4,185. But Venkys has been a marked outperformer as far as this year is concerned. Today it's cooled off, but will the rally continue? Dharmesh, any view on Venkys?
Yeah, it's a good stock to hold in the portfolio. The company has again seen a turnaround, but that has reflected in the numbers which they has been posting. The entire concept of Venkys is like frozen foods and cold food concept, ready to eat kind of food which you get prepared in say 5 to 10 minutes kind of a time frame. Going by nutritional aspect of the Indian organization, they say it's still one third of what the consumption should be of poultry and poultry kind of a business. So they are into that area. You name delicacy related to poultry thing, and they have a ready-to-eat kind of a package out there. Market traction has been very high, and going by the way the lifestyles are, where both the couples are working, husband and wife both, so they have limited time to cook the food. So that is I think is a key trigger. And acts are put into the place of Venkys, so valuation comfort is still there.
Okay, what about you, Senthil? Will the rally continue on Venky?
So I don't think so, because majorly on the valuations front, it's not attractive. Plus on the business side, I think if you see there are three segments. One is the poultry, and the second is the animal health, and then third one will be the oil seed business. So poultry business has seen a turnaround in the last 2 years, majorly because the poultry prices have been inching up. Plus their raw material paints have been going down.
Yes,
because the soya and maize has been declined because of the good monsoon. Because of that, the company had a dual benefit, and the margins in the poultry segment, which used to be in the loss making, is turned profit. In the Q3 we saw, I think the EBITDA margins in the poultry segment is around 11% compared to -1% last year. And management also in one of the interviews mentioned like it's too difficult to predict or forecast the poultry prices. Because you have to forecast the farmers, how they are going to produce in the next year. Because farmers, if they see profit in 1 year, they will overproduce in the next year. So that will automatically result in fall in poultry prices. So, and we have to check in the raw material prices for the next year. So a lot of variables built in the company, and the current valuations predict only the positive forecast.
Okay, so Urmil does not have a view on this. They don't track it. So we'll throw open the discussion here. How big of a cyclical risk does Venkys have? Because the rally has mainly been on account of price increases in some of the drugs and the oil seed and the raw material costs that have come down.
Right.
So if that reverses, how big of a risk is Venkys taking?
See, I don't think so that input prices going up will be a risk for the Venkys, because they have expanding their own capacities as far as hatcheries are concerned, and this is known to the management. So definitely steps have been taken into place, and the way the food traction is taking. If you go to any mall, earlier when I used to visit malls, I used to see lesser of Venkys product. Now you go to any hypercity kind of a mall, you see Venkys are flooded with, and people are buying that. So that is reflected out there. So basically my own sense is 15 to 17% kind of a CAGR growth should be there on the earnings front. And these companies do get a premium valuation for their FMCG, and it's trading at 30% discount to again most of its peer in this same area. So that is all, it's a good valuation bet to my sense.
Okay, so I think we are running out of time on this show, but with that, it's a wrap on this show. Urmil, Dharmesh and Senthil, thank you so much for joining me. But we are present at the Axis Capital. They are holding their 4th annual auto conference today. And Bloomberg Quint's Yatin Mutta caught up with the Deputy Head of Research at Axis Capital, Ashish Nigam, to get his views on the growth prospect of Indian auto companies and what he's making of the vehicle scrappage policy. Here's a slice of conversation from that conversation. Let's hear it.
The investor mood is actually very, very upbeat, because the next 2 years for the auto sector can be defining moments for a lot of companies. So typically, we like to have a good blend of OEMs, ancillaries, dealers and finances at the conference. But this time around, we've consciously kept it more towards auto ancillaries. Because that's the space we're very excited about. So out of 15 companies that are attending, 10 are auto ancillaries. So I mean, right now you had a case where some stocks have sort of cooled off, but that hasn't lowered the interest, because it's not a change in fundamentals in any of those companies. It's just more a case of people sort of selling their winners to rebuy their losers in other sectors. But the outlook for the next 2-3 years is so strong that people are actually using this platform to cherry pick the winners over the next at least 3 to 4 years.
Okay. And since you track the auto sector so closely, on the commercial vehicle side, we are looking at some very good, monthly data which is coming in. The auto ancillaries servicing to the commercial vehicle segment are also quite upbeat in terms of capacity utilization moving up, orders picking up. Globally also we have seen, data points like Class 8 truck being quite encouraging. So do you think the commercial vehicle cycle is probably, the trend is here to stay, or probably this is a small blip in the data points, or probably it may cool off the growth rates that we have seen historically? or do you think that the feedback that you're getting from companies and the view that you have as a house remains upbeat on the commercial vehicle segment, companies and auto ancillaries servicing to the segment?
So the commercial vehicle space right now is in a mid-cycle.
Okay.
There was this view that, the commercial vehicle sector growth has peaked out after 2 years of good growth. But you're coming off such a sharp down cycle that the upcycle can be 4 to 5 years.
Okay.
So you are in a mid-cycle where the growth is expected to be there. You still not crossed the previous peak. Now, what's really helped the segment is that there's been a more stringent ban on overloading.
Right.
There's been a recovery in mining, there's been a recovery in road activity, road construction activity, easier financing, which has driven the growth. So our view is that even though you've had 3 years of strong growth, FY19 will be another year of strong growth. So by strong, I don't mean maybe, it's not going to be that 25-30% days are behind us.
Right.
It'll be more a case of, I don't know, maybe 12 or 15% in FY19. And FY20 could be even stronger because of a pre-buy before the emission norm change.
Okay.
So the emission norm change happens in end of FY20, beginning of FY21. So your vehicles, commercial vehicles will get more expensive by maybe 10%. And besides the price increase, the BS4 vehicles which are available now are easier to service and maintain.
Right.
So you will see a very strong pre-buy, probably the mother of all pre-buys in commercial vehicles towards the end of FY20, which is why FY20 will also end pretty well. FY21, we're waiting and watching. To my mind, it could be a down cycle year because you've had 5 years of strong growth, you'll have the pre-buy also behind you, you'll have a price increase. FY21 could be a down cycle year. But now the joker in the pack is what happens with this cash for clunkers.
Yeah.
That's the whole thing. I mean, the government's has done some pretty absurd things in the name of pollution. You're jumping from BS4 to BS6. You ban, over 2-liter diesel vehicles.
And the scrappage policy as well is coming in.
That's the better way to curb the to tackle the pollution. No, today you have 100 vehicles moving from BS4 to BS6 is equivalent of banning one BS1 truck from an environment perspective. And if that happens, ideally, I think that was something that nobody should sort of oppose. It's just what incentive should be there. Is it 10 years, 15 years? Is it mandatory, voluntary? But whatever it may be, even if it's 10 years or even if it's 15 years, there's some 1.5 million trucks over 15 years.
Right.
Probably 2 million trucks over 10 years. Versus the current industry doing 300,000.
Right.
So even if half of those come up for scrappage, and there's also talks that the scrappage certificate will be transferable.
Okay.
Unlike other cases globally where the scrappage certificate you can't transfer, only you can buy the vehicle. So there's a lot of things that are basically that can really play out with the cash for clunkers. A lot of things that are being discussed right now. But to my mind, if even half of that comes through, then FY21, FY22 could also be strong.
Right.
The reason why actually a lot of commercial vehicle stocks, etc., has been exciting is because cash for clunkers has recently come up. Okay, fine, it's finally going to go through. I think it didn't go through last year because I think just post demon, you couldn't sort of affect the
and now it's much more easier because the finance ministry also approved the proposal, and now it's just lying with the GST council, right? Exactly. And talking about OEMs in particular, so of course Maruti is the market favorite. A lot of it's a consensus buy, top pick. But the share price has come down from the recent highs it made, and similarly is the case with Tata Motors down 20% on a 1 year basis, and most OEMs have corrected, barring 1 or 2 names or probably Ashok Leyland, which is hitting record highs. So what is the strategy here? Would since the valuations are attractive, your target prices are probably on the higher side. What is the strategy or recommendation to your clients? How are you approaching auto stocks now?
So what we've been telling people for the last year or so is that the underperformers and outperformers of the sector will be driven by the emission norms.
Okay.
Emission norms and safety norms also. That's the mega trend that's happening over the next 2-3 years.
Okay.
And there is a significant cost increase for the OEM, and that same cost increase is a content increase for the auto ancillary.
Okay.
So be it PVs, be it CVs, be it two-wheelers, there's a significant cost increase that's happening, and the auto anchs that are benefiting from this are benefiting significantly.